Thus far, you have built an investment model, created forecasts, and determined the optimal holdings for your portfolio. Suppose you invest in the optimal holdings from 4/15/2015 to 10/09/2015 and want to measure your performance. This guide will show you how to evaluate the performance of your portfolio and each investment relative to your forecasts. Click Network and then the Evaluate button on the ribbon. Enter 04/15/2015 as the begin date, 10/09/2015 as the end date, and click OK. Click the Portfolio button on the ribbon. Click Unconditional Statistics. Click the plus button next to the scores to expand them. The graphics show the scores of the unconditional probabilities and expectations for the portfolio. The Validate column calculates the difference between realized and forecasted results, whereas Evaluate calculates the difference between realized and historical. In general, the forecast probabilities and expectations were close to the realized results. The one exception was the difference between the realized and forecast large gain expectations. An investigation of portfolio performance over time and the scores of the individual holdings would reveal the source of this discrepancy. Click the Node button on the ribbon. Click Unconditional Statistics. Select XOM. The scored probabilities for the realized versus simulated results are much further apart than the realized versus historical data. This suggests the analyst has no forecasting skill. Click the Node button on the ribbon. Click Conditional Statistics. Select XOM as the node. Click the plus buttons next to Validate and Evaluate Conditional Probabilities and Regression. This shows both the simulated and realized conditional probabilities. The realized values appear more concentrated along the diagonal, which indicates the U.S. market and Exxon were more highly correlated than the forecast anticipated. Although the forecast and realized slope are identical, the higher realized R-squared confirms that the U.S. market and Exxon were more correlated than forecast. Click the Node button on the ribbon. Click Time Series. Select Exxon as the node. Click the plus sign next to Rolling Standard Deviation charts and Rolling Correlation charts to expand them. The rolling standard deviation shows the initial forecasts were too high compared to the actual results. But then the share price of Exxon became more volatile starting in mid-July 2015 and the forecasts were reasonable. Similar to the rolling standard deviation, the rolling correlations show that the initial correlation forecasts were too high and then were accurate later on in the evaluation period. Unlike the rolling standard deviation, correlations started increasing in early August 2015. In general, correlations between stocks tend to increase when the market becomes more volatile. The evaluation chart follows this pattern. This tutorial showed you how to evaluate the performance of your portfolio and each investment relative to your forecasts. Thank you for watching.